And welcome to the Prescribing Prosperity Podcast with John and Alex Soutsos. Gentlemen, how are you?
I'm doing well, Bill. Good to see you again.
Great to see you. Alex
Great
is nodding his
too,
head.
Bill.
No, it's okay. I like seeing you, Alex. You don't have to like seeing me. That's fine.
No, it's great to see you too, Bill. I always get excited when we get to have a conversation. So,
I like this one. I like this conversation because of the guest and what you're going to explore. It's going to be a two-parter. And we're going to be navigating the media narratives and the financial market futures. So without any further ado, let's jump right into this, gentlemen.
Excellent. Well, Rana and I go back a very long time. And he was one of the original founders of Investment Planning Council, or IPC for short. And he has moved on recently to a new position and a new company he created called Victory Hill Capital. So, Rana, perhaps you can tell us a little bit about your journey through IPC in an abbreviated form and what led you to your current role and focus.
IPC is a great organization. It's a planning organization. All right, and it started in the early 1990s when there wasn't much emphasis on planning. And by doing good, we gradually saw advisors join us who were like-minded in having a planning focus, and that's how we kind of grew the firm from there. And then the firm morphed, and now it's part of the Candle Life organization. Prior to the investment side, though, I was in the medical side. All right, I did medicine and physics, and I found that helped me a lot in understanding finance, whereas approaching finance from a traditional view is very linear.
Mm-hmm.
And coming from a medical kind of background, you're looking for causes, reasons, and, you're triaging or something like that.
Right.
Quite often. So it helped a lot in building that. I was a strategist within IPC. Eventually, as IPC grew out, I wanted to do other ventures. And that's why I created Victory Hill to follow my thoughts in investing, which are very different from the traditional thoughts. Okay, in using concentration as a key part of it, and a key part is understanding probabilities and game theory and being evidence-based. So I wanted to do that, and now we run that. Yeah.
That's excellent. And how are things going so far at Victory Hill Capital?
It's been wonderful. We have ultra high net worth is primarily our goal, and most of our clients are in the Middle East. So the wealth level there is a lot higher than the wealth level here. All right.
Right.
So there's quite a few. So you get a different viewpoint on things when it comes to the Middle East and what they want and how they're doing things. It's something that no Canadian firm has ever done, really, is step into the Middle East and understanding their needs and their requirements. So it's been illuminating in many ways.
So Rana, before we continue on that vein, just go a little bit deeper, if you don't mind, into what was your role with IPC when you first joined the organization, and how did that evolve over the years?
So at IPC, we all started off as basically with a financial planning background, and then I became an analyst inside of there. Then I helped build Council Wealth from there, which was choosing the managers, monitoring the managers, and making sure that we had the right fit for that. And then I wanted to move into the strategy role, which is trying to figure out where the world is going and what investments are needed for that. And so the team that does the planning for the managers is, the separate team from the way I was. And it was really about trying to figure out where the next Amazon, Netflix, and all the way the world's changing. Like the influence of AI right now is something that was started a long time, back in 2017, actually. All right. And we started to think about AI in 2017, not now. All right. So it's kind of looking at the next way the world is going. All right. And I have a belief which is very simple. It's faith in the future over fear of the future. All right, and that's kind of worked its way through. And we see that the future keeps on getting better in a different way, but the fear of the future is what they keep on throwing at us. All right, at each corner, you're going to keep on getting fear this, fear that, and yet, somehow we got through COVID, right? Even though that was probably the biggest fear out there, and we managed to get through it, and here we are now, and people are questioning the valuations of AI, and I'm saying you haven't even seen a real AI company yet. There's no, like the internet came in, and then it wasn't until 2004 that you saw Netflix and Amazon really take off. And so we're in the very early stages, and yet the best is yet to come.
So one of the common traits why Rana and I became good friends and get along very nicely is we have a similar view of the world. We believe in portfolio concentration. We believe in optimism about the future. And this creates a lot of frustration when we're dealing with the media and the information that's being filtered down through both the financial the financial media and the general media. So I think that's an excellent point that Rana made about fear. There's constant feed of fear-based narratives, and that generally will cause investors to make bad decisions. But I'll let you carry on, Alexander.
Yeah, so Rana, you've obviously, as your role adapted and changed over the years at IPC, that led you to kind of, it forced you to adapt and change. And I noticed that one of the things seems to be on LinkedIn and on your Facebook page is that you talk a lot about perseverance and adapting to change. So, what led you to adopt this mindset during your career?
So in most people that do finance or these, analysts and everything, they run off something called the modern portfolio theory, which was written in the 1960s. Okay, so, 60/40 and all this stuff, and they have this thing called an efficient frontier. So you're living in 1960s, 1970s, when there was no internet, when there was no other things coming up, there wasn't options around the way they are now, there wasn't ETFs and all these things. So most of the models are backwards looking. It's if you look at physics, there's classical physics, Newtonian physics, and then there's quantum physics. So you could be stuck in classical physics in a quantum world, which is actually what we're in. We're in a quantum world. All right. Newtonian was, way back as well, but we're still stuck in classical. So you've got to adapt and change. And I'll give you a perfect example of that. Until about really 2008, I'll give you 2008 as an example of it. All the cars that you were driving were combustion engine cars. But then comes an EV, or Tesla or whatever, and it was the bold change of that led to all those classical car companies trying to say we have to have our own version of that. So you saw this change go on in our lives now. If you look around the streets, you're going to see a lot of these EVs, and it's not just Tesla. There's other makes. Go to Europe, and you see, BYD everywhere. Okay, so that's a change, right? And it's a good change. It's not a bad change. They're getting cheaper and cheaper. You're going to get more in it. But had you have stuck to the traditional inefficient cars of the late 60s and 70s, they wouldn't be fuel efficient now. So again, same in finance. We're stuck so much in the old models of discount dividend methodology when the form of dividends have changed now. All right, that I had to leave that thinking behind and look at, just like the human race evolves, however we were before, Neanderthals, right, and now we're Homo sapiens. Well, we're going to do that in finance. We're no longer Neanderthals.
Oh, I agree. And you know what? It's funny you mentioned that. I'm doing right now. I'm in the middle of getting my CIM so I can have my portfolio manager's designation, and the valuation portion of it. So I've got my MBA, and so we covered a lot of this stuff that's in the CIM and any of the CFA courses in great detail in the MBA. But so they're reviewing it for me in the course, and they're talking about the most important valuation metric is the dividend discount model. And I'm looking at the page, be like, who wrote this? Like, what year is this from? Nobody uses the dividend discount model. The dividend discount model is a useless.
Can't be, because it
Well,
can't talk about innovation.
Yeah, I
You
know.
well, you'd be
cannot price
surprised. A lot of people still
innovation.
use it.
I know,
Yeah,
but
but you
it is.
can't price an innovation,
Yeah.
right? Like, think of it. 2007 was the iPhone. How could you have priced in the impact of the iPhone on
Mhm.
Apple stock at 2007 using the dividend discount? It's impossible.
Well, and at that point, Apple wasn't even paying dividends, so you
Yeah.
basically you have to throw that model out because it doesn't work. And so even
Yeah.
discounted cash flows is, and so having worked in investment banking and seen what happens in a lot of the valuations that they use, they're using more discounted cash flow models. But even then, that is very subjective to the inputs that you're putting into the model itself. And so to be forward looking, you have to bake in a little bit more
Yeah.
flexibility and nuance into your approach in order to be able to just say, well, the last 5 years, this is what they had, so we're going to project out a steady state growth model based on the last 5 years. That may be very different from what the next 5 years are going to look like for an organization.
John's been very advanced on this. I've known John for a long time, and he's a true thinker, and I think he's very different from most financial planners and investment people out there in thinking about this whole thing. Where do we go from here? And not being stuck to the last couple of models and whatever the compliance people and the other people want to throw at you because they got to tick their boxes. In the end, we're all accountable for the good wealth and the good life of our investing clients. That's what our ultimate responsibility is to them, not to a corporation. All right, whether you're at a bank or not, the bank pays your salary, but it's the clients that pay the salary to the bank. So ultimately, the well-being is always that underlying. It's in medicine. All right, it's the patient that you're looking after, not the drug company at the top.
Absolutely. So, Rana, how do most people react in the face of change? Because obviously you are somebody who is very adaptable and nimble. How do you find, in your experience, most people tend to react in the face of new information and changing circumstances?
So it's human nature to always look for the worst. All right, and so let's take a look at the sources of information. That most people don't think too deep. They will take a piece of news and assume it's correct. And then they will extrapolate that further. And it comes back from cavemen thinking, right? Oh, there's a saber-toothed tiger. If there's one, there's like a dozen of them, and they're all going to come and eat my tribe up. All right. So it comes back from there in our brain, and I get it. But the media's role, they don't get paid to give you good news. They get paid to have your eyeballs look at their website so that they can flash their ads. And the only reason you're going to look at it is if something is going to scare you. All right. Like a big snowstorm coming, right? And so all of a sudden you're going to look at it, and maybe it isn't a big storm, maybe it is, but you're going to look at it, and that's going to further advertising, which is going to put their revenue. Or, a bombing here, a bombing there. Or like we saw last year, April the 4th, April the 3rd, Liberation Day, tariffs are going to come in and tariffs are going to shoot up inflation, recession is going to come out. Like, if you looked at that week and looked at the headlines, just search the word recession, it would have been the most common word used. So what happens is people react to these strong words. Okay, and then they decide, oh, I can't be part of that, and then they sell, and that causes the drop. Whereas if you look past that and you say, okay, really, the tariffs, it's going to bring revenue in that wasn't there before. That's going to help. Now, I'd rather follow demand rather than not. So if it's bringing money in, you follow that. If it's bringing money out, you don't follow it. And then you saw the rapid recovery. The markets went up 43% from April the 4th upwards. So if you had listened to the news, you would have missed that recovery. All right. So again, this is constant though. You look at any day at either YouTube or the headlines, you'll probably see most of the time, 9 out of 10, they'll say something's going to go bad.
Yeah, constant clickbait. I'm on Seeking Alpha as one of my
Yeah.
sources of information, and there are independent analysts who are on there, and the majority of the headlines are all negative because they want you to click and read their article. And there's one guy in particular, and I'm not going to mention any names, but he hasn't had a positive article or headline in 5 years. And I'm thinking, how do you stay in business? Because anyone who bases their decisions on the future getting worse instead of better is going to lose money and eventually be bankrupt. So obviously, you can't believe a lot of this stuff. And Rana, I don't know if you are aware of this, but I started my career 40 years ago. So I've been seeing this stuff for 4 decades, and I learned very, very early on, thanks to people like Sir John Templeton and Bob Kremble and others, giants in the investment industry, portfolio managers, that said you can't follow these headlines. You have to understand what drives markets, and it's not fear. You need to be optimistic, but not only that, the fundamentals are corporate earnings growth is what drives markets, and everything else is noise.
Yes. But what drives corporate earnings is demand.
Yeah.
Mhm.
So whatever there is a demand for, that will gather more earnings, and earnings is what feeds a company, pays the payrolls, pays everything, and what's left over is cash flow that they can then use to do whatever they want to do with to enhance the business. No company wants to be a value company. No
No.
company wants to
No.
be a company whose stock goes down.
No.
All right. So they'll do whatever they want to, whether they'll lay off people or anything, they'll do whatever they have to preserve them. It's survival of the fittest. So survival of the fittest means adaptation, like Darwin's, adapting. All right. So
That's actually an excellent point, Ryan. That's the biggest message from Darwin is not necessarily survival of the fittest. It's survival of those most able to adapt.
correct. And you're seeing that in companies, right? You're seeing right now companies adapting. About 40% of companies next year is going to increase the AI usage within their companies. Now, there's a flip side to that though, is that there will be more layoffs. All right, because the productivity is being enhanced by AI to it. So those people that are laid off, they need to start talking to a planner now about what do I do when I get laid off? What kind of skills do I need? So this whole planning side has to change, not from retirement. There's a pre-retirement, which is called a layoff, and start thinking about that now rather than wait for the very end.
Absolutely. And I think that's a great point. And it's something that we've talked about before is, you just because something changes or just because what you're currently doing no longer exists doesn't mean that you cease to be employed, period. There are structural changes that occur constantly over history. We don't see people whose primary employment comes from building railroads or working on as train conductors or maintenance people for trains. We see
Or
people
buggy
who
whip
then
manufacturers.
yeah, we see people move to automotive, which then move to aviation, and and then in the telecommunication space, years ago they were using phone or telegraphs, and they were using Morse code, and then we started using wired telephones, and then it moved to cell phones, then it moved to the internet as a form of
Landline.
communication. Like these are all innovations and changes in technology that have forced people to adapt and the nature of jobs to adapt. They've been talking about the fact that their jobs will cease to exist. I can't remember the latest I've seen in terms of an article about it was dating back to like the 1700s. They're talking about there's going to come a day very soon where humans won't work, and the anticipation of the industrial revolution, and humans won't work, and it's not true. It's just
No, you'll
the
always
way
need
we work
some
will be
form.
different.
Yeah,
What is
the
what?
form will change. So greatest, so my measurement of success is when the person that we're investing for, I can say to them that you no longer need a job because your investments are giving you as much income as your job is. Then you can work for the pleasure of working. So to me, that's the ultimate of financial planning is eliminating the need for a job because your investments are working right. And it starts early. Sometimes it starts with a lot of understanding the markets, taking advantage of the opportunities that happen. All right. All markets aren't the same. You will have a down market at some point, but how to take advantage of that? All right. How to prepare for it's game theory or when you're going to be wrong. All right, and how to take advantage. So I believe that if, with proper planning, everybody can eliminate their need for a job if they have a good planner.
Absolutely. So one last question here on the subject of adaptability and change, and that is, how do you think people should approach failure to better position themselves for success? How should they reframe their mindset so they become more adaptable?
So reframing the mindset is one is realizing that the negative bias out there is 80% more than the positive bias. All right, there's just so much negativity out there. And not to weigh that as much as the positive bias that you have. Also, understand what you're invested in. All right, like look at people around the world that are using what you're investing in. I'll give an example, and probably everybody here. There's not too many people in the world that don't use Microsoft. All right, that operating system is everywhere. And let's go one step further on it. There's only two uh, cell phone operating systems in the world. You're either Android or you're Apple iOS. So you've got that right. There's only two gas turbine companies in the world: Siemens and GE Vernova. All right, when you start looking around the world, how many streaming companies are there? Basically, there's only one and a little bit of the others. All right, so people use Netflix. All right. You probably have a Netflix account. Everybody that I know has a Netflix account. They're all paying every month into it. Guess what? Netflix has done very, very well. I mean, there's going to be ups and downs to it as people make perception on it, but it's not a company that's going to go belly up right away. Competition could change it. And when that happens, then you'll notice that there was a Blockbuster before there was a Netflix. All
Well, and
right.
then
And
there
now
was
Netflix.
there was Netflix at the same time as Blockbuster, where they both were in the same space and competing. But it was Netflix's ability and willingness to adapt and evolve that allowed them to leave Blockbuster behind.
Yeah. And I believe personally that we're at the very beginning stage of AI. We're not at the ending stage yet. We're at the very, very early. So I'll give you a perfect example of how I used AI basically the other day. I went grocery shopping. I took 3 pictures of 3 items on it. I went to Perplexity, which I kind of used, and I said, find me the cheaper prices than these 3 items in an area of 3 miles around me. And it told me right away, this one is at this other store for this price, significant discount, by the way. So that was within 2 minutes, which literally within 2 minutes of me putting an item out there. So it changed the way you start thinking about groceries, all right, or shopping, or Christmas shopping, or anything like that. Amazon's changed the world of shopping because of COVID. COVID happened. We all had to order things in. And yet the AI company that's going to change us hasn't even arrived yet.
Agreed. Now let's put a pin
We're
in
in
that
the
because we're
chip
going to get
phase.
to AI in a little bit, Rand. I want to get more into it with you because I think that's a huge topic that I don't think people fully appreciate the scope of. We see a lot of superficial headlines that are misleading to people, and people read them and think, oh yeah, AI is in a bubble. And anyway, we'll get into it in a moment, but. Let's focus first on the evolving landscape of the financial markets because I don't know about you, like, and I've been around a lot less time than you guys have in terms of my career. And so I'm going to lean on your perspective and your experience here. But do you think that media narratives have always been such a major driver in market narratives, or in market movements, I should say? Or do you think that the media narratives have driven it more now than they ever have in the past?
I think it's more now than it ever in the past, but it did have an impact. Because remember, John, I don't know if you remember, you probably do. We only used to watch the news at 9 o'clock,
Yeah.
right?
Well,
CBC at 9.
well,
CBC.
6 p.m. and 11 p.m. in the local Toronto area.
Okay,
Yeah.
6 p.m. and 11 p.m., right? I used to be in
Yeah.
England, so it's BBC at 9,
There you go.
right? So that was all the news we had. And then we never thought about the news until the
No.
next day.
Right.
Right, with the advancement of phones and the collapse of newspapers, right? We don't get the newspaper anymore, so now we're all going on to collect bait and everything. You're getting so much news at the same time, and they have to keep on changing it. Right? You know, like every minute they have to find a news item to talk about.
Well, update the
So
head.
I
Yeah.
believe now it's far more than it was ever before, and the anxiety level in people has increased. You're seeing so many more mental illnesses now than there was ever before.
Yeah.
Right. Just our blood pressure alone has increased now than it was ever before. We don't go out for walks as much as we used to. We don't exercise. We don't eat. John knows this better than anybody. You don't eat healthy as we used to before. Why? Because we're, constantly in anxiety.
Stress for time, have
Right.
to make quick decisions. And let's face it, the majority of the population is not built for quick decision making, and they rely on what we call heuristics or mental shortcuts, which the media conveniently provides for us.
And everybody's telling you get rich quick, buy this stock, buy that, this, and then after it goes down, they disappear. You know where these people are.
Well,
There's no
I got to tell you,
accountability.
Ren, you probably get this as much as we do. I hate the question when somebody comes up to me and asks, and they find out I'm in finance. Oh, what's your big stock tip right now? I don't have one. I don't have one, not because I don't have companies that I like or I think have, viable
I
business
agree.
models, but it's because I'm not going to get, you're not, it makes me look bad, or I think you're going to think that I'm going to give you some stock that's going to make you rich overnight, and that's not the case. Second of all, my opinion could change on a stock very quickly, and I'm
With
not
new
going to be there to
information.
call you up and say, yeah, by the way, I decided to sell. You should sell too. Because that's not, I don't have time to call every single person I know who I've talked to about a particular company to say, I don't like them anymore, get out.
This is why
So,
BNN in Canada and CNBC in the US is so useless, is because they bring out these talking heads and they say, oh, what stock do you like now? And they talk for a few minutes about these companies, but what the viewers don't realize is they could change their opinion, or their motivation for talking up that company may be different than your motivation. They might be trying to sell the stock, and they're talking it up, saying, "Oh, well, this is a great company, blah blah blah," and just so the price goes up, so they can get their position out. But my response to that, Alexander, is, you want a good stock tip? Buy my investment portfolio.
and the other thing I wanted to mention to you, Rana, was, related to this subject is in the past, we've seen, full market cycles, peak to trough to peak again, are generally 3 to 5 years. Since I have started my career working with my dad, we have probably seen at least two, if not three, market cycles
At least three, if not
in
four.
in the 3 years that I've been here.
Oh, in the 3 years,
I
yeah,
yeah.
you're right. You're right.
So
You're right.
obviously the pandemic, which I went through when I was doing consulting, was another full market cycle. But
It's
it
22
seems to be
that got.
happening. What's that? Sorry.
Yep. It's 2022. You trial by fire.
Yeah.
Exactly,
Right.
exactly. And so, when we talk about it now, we go out and we frequently talk about, clients ask, or prospective clients, a lot of times they ask the question, well, what if I can't afford to be, as I get into retirement, I can't afford to be in an equity portfolio because what if there's a big correction, and one of the things that I've been talking about recently with people is I don't believe that that's a major consideration anymore, because what used to be even a 3 to 5 year correction, for realistically, you're not going to burn through all of your money in 3 to 5 years. But let's just park that to the side for a second. Market cycles nowadays are so much shorter because of what you said before. It's the proliferation and the velocity of information that gets absorbed into the financial markets and priced in almost instantaneously, to the point that we go through full market cycles in a much shorter time, because it takes much less time for that information to be absorbed and impacted into the market, and then the market waits to see what happens, and in very short time they find out whether or not the narrative that was created was true or false, and it reacts accordingly. Going back to your example of the inflation narrative in April. Everybody was talking about we're going to get all this inflation. We're sitting here on December 22nd, last Friday, Thursday or Friday. We released the latest inflation numbers,
So,
and it's the lowest annualized inflation numbers we've had since the pandemic.
Did you go
So,
back to
and
the
even
economist?
even that data is delayed because the live inflation data is on Trueflation.
But did
mhm.
anybody go back to those economists in April that said that the world was going to end? Did
No,
anybody go back to and says, "What do you think? Maybe we should fire you from your job because you have a
exactly.
terrible track record."
Well, you know what, Rana, the same question can be posed of people who are dealing with the large financial institutions like the banks and insurance companies. Those companies who also promoted that narrative, have you fired them for giving you the wrong information and causing you to make bad decisions with your money? No, I write a weekly newsletter, and my thoughts at any point in time are documented. And if you go back to my April 5th newsletter, I clearly state that tariffs are not inflationary. If anything, they're deflationary. And all this discussion about a market collapse and all that is nonsense. So we gave the right advice to our clientele and to anyone else who reads our newsletter. But people are invested with the banks and insurance companies. They got bad advice, they made bad decisions, and they're not holding those people accountable.
Yeah, unfortunately, when you deal with an institution, you get institutionalized, right?
Yeah,
Okay.
institution think.
Yeah,
Yeah,
groupthink.
institutional thinking, because the institution's about protecting their wealth, not your wealth.
That's
They've
right.
got to
That's
keep
right.
it just enough that you don't leave, but not enough that you actually make money so they can earn their higher fees and all this stuff. And they say, oh, we're charging lower fees, but they're not really, because they're spread out over many, many more people. So, there's a reason why banks and insurance companies have the biggest offices they're paying tons of rent on these things. All right. So there's a reason for it that they get to collect the bigger earnings.
Absolutely. So, I'm sorry, I didn't actually pose the question, but I believe I got your answer, in that you agree that the financial market cycles going forwards, you agreed that they will be shorter in the future,
Yeah,
Rana?
much, much shorter, much, much more reactionary. And you can see it in the movement of a tool called the VIX Volatility Index, how quick it goes up and then it goes down. You can see it in there. Okay, so I think the world's gotten smarter, all right, in reacting to this is, I'm going to, use the word bovine fecal matter. All right, this
Yes.
is real. And unfortunately, we've got a lot of bovine fecal matter out there.
mm-hmm.
Okay, and we've got to cut through that. It's like people like John and yourself that have to, go through it and say, no, this was total, you know,
Yeah,
that, and
garbage.
this is not real. This is,
Yeah.
and here is what is really happening.
So
Okay.
so how do you sort through that noise, Rana? Because that was one of the questions that I wanted
So,
to
so
get to.
first it is understanding how companies and are evolving and the changes that are happening. I look around us. We look for where demand is and things like that, and we look at the innovation changes. I believe innovation increases productivity. All right, productivity increases earnings, and then but that's all built of demand, so the demand has to increase, and then those companies that take the productivity increase in the cash and use buybacks to increase their earnings and to do something good with it, those are the type of companies that we look for: free cash flow, increasing in buybacks, the earnings based off demand, not financial funny accounting. Okay. And strong, well-known names that we look at, and sometimes you'll find a small name that is being bought by a lot of big names. So it does come down to common kind of sense, really, which unfortunately is not as common anymore.
I know it is unfortunate. Do you have any examples, Rana, of and it's obviously not an investment recommendation. I want to put that out there
There,
before
there,
anybody,
there's
but
there,
where you
there's
followed the
plenty of
money.
examples. Yep. So there's plenty of examples of great innovative companies that we've all known about. I'm not recommending, obviously, but take a look at Google. Right? Google is in every single sphere of AI. That means they make the chips, they have the software. They're the only company that is completely vertically aligned to AI. And yet they're basically they're basically the monopoly in search, right? And then you saw Gemini 3 came out, and that made a big difference to it. It's in it, Google has Waymo, the car company as well, right? So think of that. Like, there's an example of a company. Literally, the whole world uses Google
And YouTube.
and YouTube, right?
Who
So
watches TV anymore? Everyone watches YouTube.
yeah, exactly that, right? So you start to see companies like that. The quantum computing is something that's maybe 3 to 5 years out, but Microsoft has a major runner, which is their new chip, and it's fantastic. Like, it's whatever Nvidia does now, this does 10 times that, 10 times faster. All right, so you're going to see the changes happen. Okay, Apple is another innovative company. You went from a phone company to a watch company, right? So you see that if you look around you, you just see what people are using. You're going to see these innovations, and like, I'm not a big fan of OpenAI. All right, I think of OpenAI like AOL Online. Right? Remember when there was AOL
Yeah,
Online
yeah.
or Netscape? Netscape. Well, that's OpenAI right now. So there's a lot of interest in it, but they're spending a lot of money, but not getting the real revenue for it. But those companies that will move further on than that, the Perplexities of the world and the next generation, okay, they're doing Comet. Comet is the browser that Perplexity brought in. That's changing the way that AI browsing is being done. So there is, and even the banking industry, right? So JP Morgan's working on a AI advisor. All right. So they're replacing their advisors with an AI that does 80 to 90% of what an advisor does. The advisor is still there, but this is the tool. So all the paperwork, the KYCs, the compliance is
Yeah,
gone.
the
All
nonsense,
right.
as we
Like,
like to
imagine
call it.
getting rid of your compliance department, and it's
Oh,
all
Oh, that'd be
AI now.
wonderful.
yeah.
Okay, so these things are happening, and the evolution is that you're seeing it mostly in America first, because their banks have the money to do it. All right, and eventually it'll come into Canada. We just don't have enough competition in Canada to improve Canada. Like, we only have Bell and Rogers. I mean, once AI kicks in into telecom, it'll change things again. Once AI kicks into the electrical grid and changing our electricity so it's dynamic pricing right across and much more efficient, so it's per household as opposed to per region, your housing will drop. Now think of your property taxes. Right now, you pay a property tax because you have a school in your area. And you have to have a fire station and a police station, so your property tax goes up. But even if you're further out, you're still paying the same property tax as the guy sitting next to the fire station. All right. Well, AI on that will change it so that your property taxes gets less the further out you go, because you don't need as much as the services as before. Maybe your kids don't go to that school, so you're not supplying that revenue to that school. So we're going to see a huge customization
Yeah,
to us. And there are
absolutely.
all
So hold
these
on one second,
companies.
Randa. Just 1 second.
Yeah.
I'm just gonna jump in here for a sec because we're gonna take a break here momentarily, and I want to dive really deep into the AI subject here because I think there's a lot of meat on the bone here that we can chew on. But one last quick question on the financial markets before we wrap up for the break, and that is, do you think that the market is more susceptible to manipulation now than it ever has been in the past?
Sorry, could you repeat that?
Do you believe that the financial markets have become more susceptible to manipulation?
I believe the fact that there are more options out there now, zero dates to expiry options, increases the amount of play around it. Okay, I'm not going to call it manipulation, but play. Market makers, which are the brokerage houses that back these options, have to sell them. And there is way more hedge funds. And hedge funds can be leveraged as much as 3,000 to 1. All right. So think of it. Your mortgage is leveraged 5 to 1. You put down 20%, they give you 100%. But a hedge fund can be leveraged 3,000 to 1. Then they go out and buy these zero date options expiry. So you can create a lot more volatility now than ever before. And it's
Right.
always around these options expiry dates.
Yeah, and I think that's a great point because that's something that we've seen a lot of is, the options expiry every month, and particularly around when you get the quadruple witching.
That was a week and a half ago. Yeah.
Yeah, you get these massive fluctuations as and it's exactly that. It's the market makers who are holding the options are selling off inventory in order to try and move some of those options out of the money in order to not have to pay such a big payout when it comes
And
to
they use
option
the news
expiry.
for it. And
Yeah.
they use the
that-
news for it.
Yes, they do. And the interesting thing about this particular options expiry this month is normally you get the increased volatility from the Monday to the Friday of the options expiry, but in this month it happened the week prior. So they're getting more sneaky about it. They're jumping in a little bit early to liquidate their contracts, and so we saw tons of downside volatility, not this last week, but the week before. And this week was the opposite. We had a big rally at the end of the week. So anyway, we'll leave it there.
Yeah, we'll throw it back to Bill, and Bill will let you land this plane in order for us to get into the next episode.
Yeah, no. This is a fascinating conversation. I'm just going to add one brief thing to the current conversation before we get into AI, and that's a question about the media narrative. And and Rana doesn't know this, but I spent several decades as a business and financial news journalist. And I would argue that the voices in the market are the voices in the market. They've always been there. What media has done, because they needed to, is they amplified those voices. And in amplifying those voices, suddenly we think, oh, we should pay attention to those voices.
Yeah.
But the media decides where the spotlight's going to land.
Well, yeah, and the joke's on the listener, because those voices have always been there, and the people in the market have always known that those voices were there, but now they're throwing them out there, and the net result is that it creates hyperbole, and it creates a misleading narrative. And and I ultimately agree with pretty much all of the comments that were made in terms of like looking at that media narrative and being very careful about listening to it, because as you have all pointed out, you do not know the perspective from which those voices are coming. And everybody, when it comes to money, has a perspective. Never forget that one, okay? Now, AI. This is going to be great because, I don't have that much time, but I think we could talk about 6 hours on AI. So let's end part 1 and get ready for part 2. And Alex and John, before we go away, just for people who are listening who are not clients of yours and are not familiar with you, how can they get a hold of you if they're thinking about maybe this is an interesting conversation to start a relationship with y'all?
Best way to reach out is to send us an email at info@med-wealth.ca or visit our website at medwealth.ca.
And again, that information's in the show notes. So if you don't have something to write it down, go back later when you got a pen and a pencil, and you can write it down and reach out to the guys. The other thing I would ask is if you're not a subscriber, hit the follow button. Become a subscriber, because you do not want to miss part 2. And if you're a subscriber, you'll be notified when that episode is released. Until next time, I'm Bill Tucker on behalf of John, Alex, and everybody at MedWealth Financial. Thanks for taking the time to listen. We'll catch you on part 2.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.